QuickBooks Online 2025, entering beginning balances from a prior accounting system, as well as adding customers, adding vendors, adding service and inventory items overview. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are in our QuickBooks Online Get Great Guitars 2025 Project File we set up in a prior presentation. After having set up the QuickBooks file, the next step is to lay down the foundation in our analogy, that being like the infrastructure that we have to put in place before we start to construct the buildings, say in our city, remembering that the infrastructure is something that ideally we want to put in place first, it possibly needing maintenance from time to time, but it's not part of the normal cyclical nature after having been put in place. The thing that's going to be normal cyclical nature is building on top of the infrastructure, which would be the buildings that we're going to be building on. That's going to be the normal kind of process in our analogy here to the construction of the financial statements. Balance sheet, income statement, and related reports. So most of the bookkeeping work will not usually be this infrastructure, although this is critically important if you're going to build anything on top of it, but rather the actual day-to-day data input, which is usually done with the forms, which can be found in this plus button, broken out by cycle, customer cycle, cash ultimately coming in from customers, vendor cycle, cash ultimately going out. These forms will build the journal entries that will have the debits and credits or the accounting equation impacted to remain in balance that constructs the financial statements. But if we don't lay down a good infrastructure, that's going to be a problem. So remember that if you are a bookkeeper, oftentimes you might be picking up new clients who don't have any bookkeeping set up yet, or you're picking up clients where their prior books was a complete mess, and now you're going to fix them. Oftentimes, how do you fix them? You start a new company file possibly and say, I'm going to start it as of January, pull in the beginning balances from the prior system and try to clean things up as we set it up anew in the current system. That's one way, common way, that you might basically try to fix a prior system, noting that that's a specialty area in and of itself, and it's kind of different than what you would do if you go working in an accounting department. You go work in an accounting department, you're going to be working on a system that's already set up and learn how it's set up and then repeat the cycle that you have seen in the past, hopefully it having been set up properly. Although you could be a specialist in adjusting larger systems, right? It's messed up, you're the one that goes in and fixes it, and then you maybe leave after that. I'm the fixer, I fix the system, and then I train someone how to use it, and then maybe I move on and fix another system. But if you're a small bookkeeper, whether you like it or not, you're going to end up being in the business of fixing the foundation, because oftentimes people have experimented with their own fixing of the foundation and messed it up, or they've hired people that don't know what they're doing and messed it up, right? So that's what we're going to be looking at here, the foundational items, remembering that you can kind of look at the version of the test drive to practice this, but it's not as easy because the test drive already has data in it. This file doesn't have any data in it, so that means we're going to practice setting this things up from scratch. What are those foundational things, those infrastructure things? Remember, those are the things that are basically in the cog here. So we set up the settings already. We set up our users. Let's take a quick run through the rest of these. Customer form styles, that's not critically important, but you might put that in place. The chart of accounts, remembering that we have been given a chart of accounts by QuickBooks, and we have a couple options for the chart of accounts, that being, do I want to eliminate the chart of accounts they gave us and then try to build our chart of accounts as we go, which means we're going to have a much cleaner chart of accounts, but it also means that we have to have a bit more accounting knowledge in the types of accounts that will be set up, or we can keep their chart of accounts, as we'll start to do here, and use the ones that are relevant to us, possibly do 1 to 2 months of data input, and then go into their chart of accounts, look for the accounts that have not been used, and make them inactive, making future bookkeeping easier because we'll have less active accounts. We might talk more about that later. Workers' compensation specific to payroll. Desktop view, we looked at that, additional info. And then the lists, the primary lists being the chart of accounts that we just looked at, and the products and services. So you have the products and services here, reoccurring transactions, attachments, custom fields. If you need any custom fields that you know of, you can add those, but the default fields are usually pretty good. Tags, special area rules, order checks. Typically, people aren't using checks as much anymore. Import data. Now, note that you could import data if you're moving from a prior accounting system to the current accounting system. So note what your options are, and this will be similar if it's a desktop version that is moving to QuickBooks Online, or another accounting software such as a competitor like a Xero or something, which is the closest competitor to the online software for whatever you're moving from one to the other. Then the question is, how am I going to move the data into the new accounting system? That's a painful thing to do. Most people don't, that's what keeps people from moving to a new accounting system, is that painful shift, of course. So you could try to import the data somehow from the prior accounting system, which could be nice because then you can at least generate reports that are comparative reports. But it also causes problems because that means that you're going to have all this data in from the prior accounting system, and it could import issues from the prior accounting system, meaning maybe you don't like all the vendors that they have that aren't utilized anymore, or the customers are not set up properly, or the subledgers don't tie out properly, and so on and so forth. And if you import all of the information into the system, then you're going to have to go in and fix those problems. Or you could say, look, I'm just going to keep the prior accounting system as what it is, and if you need that information, you can go to the prior accounting system, and in the current system, I'm just going to enter the beginning balances as of the end of the year, so I have an entire year's worth of data input in the current year. If I'm transferring data in the middle of the year, I'm going to have dual systems. I'll enter the data again in the current accounting system. In other words, I'm not going to start entering my data in the current accounting system at August or something like that, and then only have a few months in the current system. And then at tax time, I have to tape together the prior accounting system and the current accounting system. No, I want to enter all of the data in the current accounting system so that I have the year's worth of data that will be needed in the current accounting system. But if I want to do comparative reports, then yes, I have to look at the prior accounting system in that format. So those are the pros and cons. If you do have QuickBooks Desktop, it might be a little bit easier, but it's not perfect to import the data from the desktop version. And in part, if you have inventory, that could be a problem. If you have a job cost system in particular, that could be a problem. Why? Because the desktop version, for example, uses the first in, first out flow assumption. And the online version, the desktop version uses weighted average. Online uses first in, first out. So if you're tracking the inventory, that you could imagine that you would think could cause some problems. And then if you're in a job cost system, the desktop version doesn't have the projects functionality in the same way as the online. So when you're transferring the jobs for the job reports, that could be a more painful issue to deal with, to make sure that you're properly dealing with that. Export data, reconcile, budgeting, audit log, and this. So profile, we looked at the profile and so on. So what we're going to do now is imagine we had a prior accounting system and we printed the report, which is basically the balance sheet as of the end of the prior accounting system. So we are going to imagine that we did this. We thought about this beforehand, and we said we're going to start the new system in January of the new year, imagining we have a fiscal year that begins January, ends December, equivalent to a calendar year. And so that would be ideal then for us to start the new system in January so that I have a full years of data within the system. Don't worry about this 23. We're going to imagine that we're starting the new system in January of 2025. That means this old system would have been in December of 2024. So we're going to imagine December 2024, we went into our old system, which was, you can imagine, QuickBooks Desktop or some other kind of accounting software, or possibly we were just doing it in Excel, or possibly we just had a checking account that we were running out of and all we have is a checking account balance or something like that. We're going to take those ending balances and put them in our new system as of the beginning of the year. So that's going to be the idea, and that's a standard starting point. Now note, you would think that you can just enter journal entry, and you could, but there's going to be a problem here. So if you're in a system, or if you have a background of textbook knowledge of accounting, you would say, well, this is easy. Look at this. This is a trial balance. This is basically a balance sheet as of the end of last year. And I don't need the income statement. Notice there's no income statement. I'm not going to import the performance statement, the income statement, because it's been closed out to the balance sheet. So if I start at the end of the prior year and January of the current year, all I need to do is take the balance sheet for the prior year, which is in balance because assets equal liabilities plus equity, and enter one long journal entry for that whole thing. And I can just enter the balance sheet as a journal entry. That makes sense from a debit and credit standpoint, but doesn't actually work ideally in practice because it'll mess up the subledgers. So that's not usually the approach that we want to take. Now, also note that you might say that I already worked some in some of the time I did the bookkeeping in the old system in the new year of 2025. If that was the case, again, you don't want to start the new accounting system in the middle of your fiscal year. So what do? You run it parallel. You say, I'm going to redo the data, possibly with the help and use of bank feeds in my current accounting system, which could actually be good because then I'm running it dual at the same time to my other accounting system, which possibly can help to see if there's any problems in the two accounting system. I have the old one and then the new one. And then at some point during 2025, I drop the old accounting system and completely move on to the new accounting system, that giving you a little bit of leeway. So you might actually work that into your system on purpose. You might run the old accounting system through January and so on, even if you didn't transfer in the middle of the year, as you start the new accounting system and see if they're running parallel correctly. So you have like an internal control check over that. But we're going to imagine we start. So what's going to be our strategy if we don't just enter one big journal entry, or why can't I enter one big journal entry? Well, the problem is that like the checking account has a different account type, meaning you have to put it in QuickBooks as a checking account type because it has a subledger and it might be able to connect to the bank feeds. The accounts receivable has its own special account type. And that's because the accounts receivable within QuickBooks wants to tie it out to the subledger, breaking out by customer. Notice if I just did a journal entry for $20,500 for accounts receivable, then how is the system going to know how to make the subledger breaking out the $20,500 per customer? It can't know that, right? So I have to do this one differently somehow so I can get the subledger properly in place. Now you might not have accounts receivable, in which case that wouldn't be a problem. Maybe you only have a checking account. That makes it easier, right? Then we could just set that up. But if we have inventory, then that could be a problem, particularly if we're tracking inventory within the accounting system as opposed to using a periodic inventory system, because if tracking within the system, this number is going to be supported once again by a subledger that's going to be broken out by item, right? Meaning inventory item with some kind of flow assumption typically, which would be first in, first out, or weighted average normally. So again, if I just put this in with a journal entry, how would the system know how to give the subledger for the items of inventory that's going to support and back up this number? We can't do that with just a journal entry. So the accumulated depreciation and the furniture and equipment, PP&E, property, plants, and equipment, sometimes called depreciable assets, they also have a subledger, but in the United States in particular, we have an income tax system, which means that we have to do depreciation calculations for taxes anyways. So oftentimes most businesses, particularly small businesses, aren't going to make the subledger for PP&E in QuickBooks. Why? Because they already have to do it in the tax software for tax depreciation, even though tax depreciation oftentimes is going to certainly be different than generally accepted accounting principles depreciation. The fact that the numbers are already in the tax software would mean that I would like to use the tax software to calculate both the tax depreciation and possibly generally accepted accounting principle depreciation if I want that differentiation between the two. Otherwise, if I'm a small business, maybe I just stay on a tax depreciation so I don't need to have a different schedule for depreciation. So that means that this one will have a subledger, but it'll be easy in QuickBooks because I'm not tracking the subledger in QuickBooks most of the time. And we'll get into that more when we get to that one. And then accounts payable. Many small businesses might not have accounts payable because the payment side of things is usually when we utilize the bank feeds for small businesses, meaning we have electronic transfers from the checking account and or the credit card account when we buy things. And therefore, we're not going to enter the bill into the system, but just pay things as we get the bill. But if we're a larger company, if I can delay paying the bill just a couple days, then that could be worthwhile for a big company, not too worthwhile for a small company. In other words, if I pay a bill that's $75 today or 15 days from today, it doesn't really matter, even though there's a time value of money situation and a cash flow issue and so on. But if I paid thousands of $75 bills, then that 15-day period is significant. And if they're not $75 bills, but they're $7,500 bills, then it becomes more significant, and it becomes necessary to manage accounts payable to try to pay the bills as late as possible. All right, but if I have accounts payable, then once again, there's going to be a subledger breaking out the payable by vendor. If I just enter a journal entry, I'm not going to be able to pick up that subledger, so we'll have to do something different. The Visa account is similar to a checking account. So if you have credit cards, then you can connect those to the bank feeds. So we have a bank feed kind of issue that we'll have to deal with, which could include outstanding items that we have to deal with. Loan accounts are pretty straightforward. Typically the loan is pretty easy. We could, basically enter that with a journal entry. And then the equity accounts down here. The equity account represents if you adjust the accounting equation from assets equal liabilities plus equity to assets minus liabilities equals equity, then the equity is basically the book value of the company allocated, the amount of assets that are allocated to ownership from the owner as opposed to third party like the bank from liabilities, right? But you could have different kind of equity accounts depending on the type of business you are. If you're a sole proprietorship, one account called equity is basically it, right? If you're a corporation, then we break the equity out into usually retained earnings and then capital stock, which is the contribution of the owners. It's still relatively simple to track that way because we're just going to break out the net value of the company by equal units, shares. And then different people have different ownership values based on how many shares they have. It's more bureaucratic, which means it causes some problems to do things like distributions, dividends, and whatnot. But it's pretty easy from a bookkeeping standpoint, pretty simple structure compared to if you have a partnership situation with two or more partnerships, in which case then you have to track all of the equity accounts by different partnership capital accounts, which is a pain to do oftentimes, according to their partnership agreements, which could be more or less complex depending on the partnership. All right, so what's going to be our strategy then? We're going to enter each of these accounts one at a time. And because there's a double entry accounting system, the other side of the account will be impacted. Usually it's going to go to the equity account in some way, shape, or form, possibly go into the income statement, but I'm okay with that because it'll still roll into equity. So what does that mean? we'll enter the checking account. So when I enter the checking account, I'm going to enter an increase to the checking account, and the other side's going to go where? To equity. The system might put it to say opening balance equity. If it does that, that's fine. That's going to be a clearing account or an account that we'll have to clear out at the end, a default account that they put in there when we set up the company file, or we can put it the other side into equity directly if we're setting it up. If we're dealing with the accounts receivable, what I'm going to do is set up each of the customer balances that owe us money, each customer that owes us money, and then that will increase the general account of accounts receivable, and the other side will go somewhere. Where is it going to go? Well, ultimately it's going to go into equity, but the system's going to do that automatically and will most likely create some kind of invoice form, because the invoice form is the form that increases accounts receivable. So the invoice form will probably make some generic income account. So the other side of all of our accounts receivable will be an income. Is that a problem? Not really, because I'm going to enter it as of December of the prior year. That means even if it goes into the income account, it's going to roll into, through the closing process, equity, retained earnings, after the close of the business. And I don't care if something's messed up in 2024, because as long as things are correct as of January, the cutoff date of 2025, which is when we're actually going to do the data input in the current system, we're good to go. That's the strategy. So then if I go to inventory, what am I going to do? If I'm tracking inventory in the system, I'm going to enter all the inventory items, the cost of those items, and the units of those items, which will then calculate total inventory, populating the general ledger account of inventory. And the other side will go where? Well, QuickBooks might set up like an inventory adjustment form. So if it sets up an inventory adjustment form, the other side of that form often goes to like cost of goods sold on the income statement, or it might go to opening balance equity. Either way, it's ultimately going to go into equity, because if it goes on the income statement, as of the prior year, it will roll into equity. I know this sounds kind of confusing, but once we do it, hopefully it'll make sense. We'll just do one account at a time, and then the other side's going to go into equity one way or the other. And then we'll go same with accumulated depreciation and equipment. Because those subsidiary accounts are in another software, typically tax software, those ones are easy. I can just enter the journal entry and put the other side to opening balance equity or directly into equity. Accounts payable, what are we going to do? Well, that has a subledger. So I'm going to enter the subledger of accounts payable by entering each vendor that we owe money to and the balance that we owe them, which will create the subledger, which will then also create the accounts payable general ledger balance. And then the other side will go where? Most likely QuickBooks will make a bill type form when I create a beginning balance. Why? Because the bill form is what increases accounts payable. The bill form other side usually goes to some expense accounts, so QuickBooks is going to generate some generic expense account. That's cool because the expense account is an income statement account, which will close out to equity. So as long as I enter it as of December of 2024 before the cutoff date, then it will roll into the current equity account, even if they put it into an expense account, and we'll be cool with that. It'll be an equity. Visa, I can usually enter that pretty directly because it's kind of like a checking account in that it's going to be connected possibly to the bank feeds. We might have to deal with outstanding balances, but we'll deal with that later. We've got the loan payable, pretty straightforward because I can usually enter that with just a journal entry, posting the other side to equity directly or possibly opening balance equity. And then what's going to happen is in equity, I'm going to have a balance of $77,896. Why? Because of the double entry accounting system, right? So all of the other balances, let me pull out the trusty calculator, went into equity. And that means the double entry accounting system would be assets of $25,000 plus $20,500 plus $2,896 minus the contra asset of $7,500 plus the asset of furniture and equipment, $75,000, is going to give me net assets of $115,896 minus the liabilities, assets minus liabilities, $25,000 minus $1,000 minus $22,000 is going to give us our $77,896. $896. So even though I didn't do it in one journal entry, I did basically the same thing, right? I'm just going to enter each of these transactions, the other side going to equity in one way or the other, whether it hits the income statement and then rolls into equity, or we directly put it to opening balance equity or to whatever equity account we want. And then if all of these balances are correct, the difference must be equity of $77,896. Once we have the total equity correct, we're still going to have kind of a mess, possibly, because we won't have one equity account. We're going to have retained earnings, possibly opening balance equity, and then you might have some other, right? Those two at least. We're going to have these two equity accounts. Now, you could leave it like that and say, okay, that's cool, but you don't typically want to do that. It looks ugly because opening balance equity by default is a clearing account. It's quick. When you put something into opening balance equity, QuickBooks is saying, hey, I didn't know where to put this, so I made up an account. When you give a report that has opening balance equity to somebody else, that looks bad, right? Because it looks like it looks like you're using a made up account. So what you want to do is take it out of opening balance equity and put it where it should go. And so that's what we'll do at the end. We'll fix this balance to at least have one account in our case, because we have a sole proprietorship of $77,896, removing the opening balance equity. Now, note that if you're a partnership, that last step is just going to be a little bit more difficult, because you'll just have to take this ending balance to wherever it got posted and break it out then from opening balance equity and possibly retained earnings to the two or more capital accounts according to the capital account balances from the prior accounting system. If it's a corporation, then you're just going to take whatever the balances are in opening balance equity and retained earnings and properly break them out to common stock and retained earnings, right? And then also we might rename this account, which is going to be the closeout account from retained earnings if it's a partnership or a sole proprietorship, to owner's equity or something like that. Now, I know that sounds like a complex process, but if you do it one step at a time, hopefully you can see the logic that it has to work. And so what I want to be able to do is say I have a system that might be somewhat long, but I know it has to work. I'm not gonna just throw it at this is not, again, a tinkering situation. It's not like I'm just throwing things at the wall and then I'll kind of move things around like paint on and try to finger paint it until it looks cool or something. No, we know exactly what's happening, right? If all these balances are on at these amounts, the equity must work, and then I can just adjust the equity. Now, note, you might say, hey, look, there's more. What if I have more accounts than this? You just looked at these accounts. Well, if you have more accounts, usually most other accounts are pretty straightforward, easier to deal with than these. These are the ones that have most of the sub-accounts, although payroll, for example, is one that we're not dealing with here, which is a whole issue in and of itself, but you have a similar kind of issue with payroll. You want to start payroll you really want to start payroll with the beginning of the year, because payroll has different rates that people hit caps and whatnot on payroll. So it's a real mess if you switch payroll like in the middle of the year. You could do it. They're getting better at it. The QuickBooks can help you out with it, but it's ugly. So I wouldn't do it. I'd really try to start, if you're dealing with payroll within QuickBooks or transferring payroll anytime, to do it at the beginning of the year. But if you do it at the beginning of the year, it's a similar issue, because all the payroll reporting hopefully will be necessary for the current year-to-date information and so on. But most other accounts are pretty straightforward. They're going to be like entering like the loan payable. You just enter a journal entry. We don't have any particular need possibly for the subledger. Again, what about the income accounts, the income statement, income and expense? We don't have any when we enter the beginning balances, because we only need that's the part of the financial statements that resets like an odometer. So if we start at the beginning of the year, we don't have any income statement accounts, at least with balances in them. Now, again, you could add the income statement accounts from the prior accounting system so that you adjust the general chart of accounts so that that's consistent, but that's also possibly the area that you want to fix things in the current year. You might have an ugly chart of accounts that you're trying to clean up. So that gives you an opportunity, if we start a new company file, to try to pull in really tailor down our chart of accounts so that our bookkeeping system is going to be easy going forward because we clean things up. So we want to keep it somewhat consistent. This is a balancing act because you want to keep it somewhat consistent so I can compare to the prior year and see what happened the prior year to the current year, making it easier in that sense. But also, I want to clean things up so from this point going forward, things are better, right? So that things are cleaner going forward from this point. So that means more problems, possibly more hassle at this time. But once 1 year has passed, future periods can be compared to a cleaner set of books, making it a much easier to repeat the process going forward. All right, that's the strategy. That's the general strategy.